Alrighty. So I am a fan of planning my financials. Specifically, I would say there's been some instances where I clearly had goals to buy a house or, pay off certain debt or whatever have you. And, since being a what you call a merchandise planner for about 10 years, where all I do is look at numbers, forecasts, all that stuff, Excel has become my best friend. So what I do and what I'm about to show you is a template that I use to manage attaining my goals by really first understanding where I'm at and where I'm going. And then I actually go into breaking down each component. So this is something I use for myself. I just cleaned it up a little bit to be able to share it with you guys. So on this first tab, what you'll see is just goals, general goals. And what you're going to have to do is just bounce back and forth between all of the tabs eventually. But just the general goal here, you can see for the year, I'm breaking down the pay. Like, okay, and these are random numbers. So if I make 150K this year, what do I want to make next year or in the future? Let's just really say future state. It might be, next year, it might be 5 years. So that judgment is up to you. And overall, since this is an Excel sheet, you'll be able to play around with it and make it make sense for you. And then you have the variances. This is in dollars. So the difference between where you're at and where you're going. And then you have a percentage. So what you can see is for the pay, it's breaking down what is your W 2 and then any additional income sources you have. And if you wanted to, you can easily insert a row above, below, etc. Or you can do it this way. If you don't want to impact these others, and just highlight that, insert cells. If you, and you can shift down if you wanted to. So yeah, so here in this example, you only see a W-2, but there's no additional income. So if I wanted just to say 0 and 0, nothing there. In the future state, maybe I want 100,000, 50,000 from this other thing. So that's that. And maybe here, if you're sticking with your W-2, we're saying you're gonna have a 20% increase in your from your current salary. So for now, what you can see is you have a 30,000 difference for your W-2, down 17%. Or if you go above here, 180K away. So overall, when you're thinking about these numbers, it's just like, what do I need to do to make this 100K, this and this 50K? And even if you're your W-2, what do I need to do to get this 20% increase? Do I need to look at other jobs within my company, or you got to leave? Or, is it a bonus? Is like, what things can you do in order to get to this magic number? Other pieces of this is you have housing expenses, other necessities, and then just emergency fund. Now, all of this doesn't necessarily equal up to, say, annual, but this is just this year. Here's the goals this year that I have for myself, figuratively speaking. In the housing expenses, you could see that it's summing up the mortgage or rent, whatever you have, and your utilities. This also has a target, mortgage and utilities. Maybe you want to get a bigger house, right? Maybe you want to get that multifamily. And overall, that cost is going to be, above what you have. But you might be making money. That multifamily might help offset or get you to this additional income of 100K. So net net, you're solid with that increase. So just something to consider. In this utilities tab, this is summing up from the budget tab. So like your water, uh, let's see, let's actually go over there, budget tab. It's summing up from here. So your electric, gas, internet, water, etc. So these things are coming. And this is going from here. So going back to the goals, emergency fund. So other necessities, you have food. Hello, $100. maybe that needs to go up. You could play around with it. If you're cooking at home quite a bit, emergency fund right now for this purpose, this first set, we're saying your emergency fund is going to take your housing expenses on the yearly basis and your other necessities on the yearly basis. And you're going to do 25%. That's 3 months emergency fund. So 3 times 4, each quarter has 3 months. That's 12. So whole. But what you're going to do is just say 3 months. Now, in the target, it's saying 50. So this is 6 month emergency if you move over to this target cell. So that's how that works. Fund money, just really saying, okay, this is taking your entertainment and your travel together and flowing that out through for 12 months. And for travel, just be creative. So, 12 months, that's $200, what is that, $1,200. So, what you get is, I don't know, I did that math wrong. 200 times 12 is 2,400. I did that halfsies. So think about that. Maybe that's 2 trips for you, depending upon where you're going. But we're thinking like per month, you're saving for that big trip. So 200 per month. Um, and so, yeah, so your fund money, that's where that's coming from, your dividend investment. So this is not retirement. So if you are like me, you're looking for, hey, how can I get some passive income? And one of my strategies is dividend investing. And then I have like, I just put in a random goal, but 2,000 a month. Maybe I want 2,000 a month to help me. I don't know. Maybe that's actually going to be my fund money, and I can do actually way more with those dividends. Retirement accounts. Let's say we have 50K in a retirement right now, and then the current goal. You can see this is coming off of my desired goal of $3 million in retirement. We'll jump over to that and I'll explain that section. But overall, this is just a snapshot of general goals that you have for yourself, where you're at, taking the time to go through that, and then figuring out where you're going. Now, we'll go much further into detail in some other tabs, but so this is how you can look at it. Is annual, you have your month, and then here we're just to calculate retirement. Some things everyone needs to consider is how much money do you want to make each year during retirement, right? So, are you trying to maintain your current lifestyle, or can you downgrade? Maybe you can downgrade because your mortgage is paid off, so you don't have that mortgage. But if you have a rent that's still there, you have to think about taxes and all those other things. But your expenses likely will be quite less. So just consider that maybe this 150 can be 175. So on this particular annual salary or income, broken it down by month just for visualization. And then for a dividend expectation on an annual basis, let's say there's 5%. That's my target. Um, Based on that 5% and wanting 150K per year, I'm going to need $3 million. And you can see that formula is in there. Now let's say, oop, stuff happens. So maybe that 5%, it actually turns into 2%, 2.5%. So in here, you can see it's divided by 2. Um, so what that means is you will get, it's 3 million times the 2.5. So that's 2.5% of the 3 million in dividends. So you will get $75,000 a year. This is considering these numbers stay static. Obviously, the market goes up and down. It depends on what type of stocks you have. Are you in a REIT? Are you in like all sorts of different things? So that rate can change. It will fluctuate. If you have no dividend payments and you're trying to get rid, and you're going to end up getting rid of this cash. So it's saying I have $3 million. Let me divide that by 35 because I'm expecting to live 35 years after I retire. Current retirement age saying 65. So that's where that's coming from. So maybe you actually want to retire at 55. Didn't do the math here. And we're saying we're going to live 100 years. So you got 45 years. So that number goes down to 66,000. So if you're just going to deplete that $3 million and you don't want to leave your kids a dime, here it is. That's the way you do it. That's a different scenario to look at it. I'm going to undo. And then here you got different scenarios. So this is just something to consider. So this is at 2.5%. And you can see that actually equates. No, it won't equate because this is based off of your need. So this 75 is coming off of if this 2.5% is divided by 2, so half of that. That's how you're breaking out your annual. But the biggest thing you can look at for these different scenarios is here again. I'm keeping I want 150,000, but in this instance, my dividend expectation is 2.5%. So I actually need twice as much in order to still achieve that $150,000 per year. And again, based on this scenario, if my dividends are cut in half at 2%, 2.5%, half of that, and I have $6 million, it's saying I'm going to have $75,000 per year. The only reason this is the same is because these numbers, this here is half of this, and this is half of this. So that's all. You can kind of work through the math and figure it out yourself. So continue along. So if no dividend is if you have no dividend, and again you don't want to leave money for your children, then you're just taking that $6 million divided by the years you have left, and then that's where you have $171,000 per year to do as you please. And just different scenarios here: 100,000, 75,000. Just note, as you target these lower numbers here, um, you could see your risk factor is if you get half of the dividends that you're projecting, um, you're going to have $37,000, half of that, your goal. So it can really end up, being much smaller than anticipated. What we have here too is if you uh, don't make any dividends, if you don't have any dividends for whatever reason, markets go up and down, and depending upon when you retire, things can change. So what you could see is you divide that by the 35 years you have left. That's $42,000. And here again, same scenario, same situation. Only reason why again these match up, your desired goal versus this last scenario, is because you have the $3 million. So that's the difference there. So really, the whole goal of this is really take the time to see what you need to get. How are you going to get to this $3 million? Where are you at right now? you know you're at 2.9 million. So jumping into the next tab, here's how you calculate your W2 pay. Not going to spend too much time on there, but it's plug and play. You're really calculating your pre-tax, starting with your gross pay, and then starting to break it down. These are all calculations. Yellow means input. Your 401k, at least matching what your employer is giving. Let's say your employer matches up to 3%, you're putting in 3%. If you put in, I don't know, 10%, you can see your pre-tax starts to go down based on that 401k going higher. Let's go back to 3%. So yeah, so you key in these numbers, your health savings account or flexible spending account, your medical, your pre-tax, if you have commuter benefits or whatever have you. So you're starting off before anything is taken out. So your 150 divided by your 26, pay periods, projecting twice a month. Here you have your 6250. So you're taking out all of these pre-tax numbers, and here you have 58, 57. Then we're taking your other random taxes that come out. Look on your check, figure out what you need to have. You can do the math and figure out the percentages. So base it off the percentage of pre-tax, your after you take out your pre-tax numbers. That's what it's based on. Um, so what you do, you could see it's taking your pre-tax number, or yes, your pre-tax, uh, well, your gross minus your pre-tax deductions, and then it's multiplying here, and that's how you're getting those numbers. And then it continues to drill down. So now, after taking out those taxes, so your employee with tax withholdings, you have 38.37. Again, remember you started off with 26.50, and each of these points there was a deduction. And then lastly, you have your post tax withholdings. So anything that your company adds that you want to buy up on. Um, so these are all examples. If you have a Roth 401k, let's throw in 10%. If you want to max that out. So you can see that number goes up. Let's go back to zero. So overall, with all these inputs, each pay period, you should have 38.14 based on this chart. So use this again, add what you need to add based on what city, state, etc. you live in, country even. So yeah, just analyze your working for the man chart. Next, you can then look at your credit cards, and dump in the exports, so your transactions, and take the time to, dump them in, label each credit card. Usually you'll have your dates on there, and it'll state whether it's a debit or credit. Then you have your description of the charge, you have your amount, and then here's where you would key in what is that. This is a month calculation over here, taking based off of the date that it occurs. So what we're doing in the following step that's going to happen is analyzing your first quarter. You can do it on a monthly basis or whatever have you, but the whole point is accountability and managing your spending and seeing where you can cut back, or just knowing what's going to come up, etc. The fun thing about some credit cards is knowing which ones give you points. So if you utilize one particular card and you get all your points off of that, but knowing how much you're spending every single month is essential, so you can ensure you're paying off that credit card statement 100%. So you're not paying those interest rates that are crazy, that are like in 20 something percent, 30%, etc. You don't want to do that. So really take the time to analyze. So going into this next tab, you have your credit card expense analysis. You can see your credit cards. Let's say you have five. You have these limits. Then you have what is 10% of the limit. 10% for your credit to be in excellent credit status needs to be below 10%. Your current balance. You can note your current balances. So what's the difference between having 10% and your current balance? That's what this is. So right now your current balance is zero, so there's no difference. Right now you have a balance of $500, but to be within 10%, you need to be at $1,500. So there's nothing that you need to just push through in order to stay below that uh, 10%. Let's say that's in quotes. Here, you can see you have a balance of $5,000, but to be at 10% below, or 10% are equal right now, I'm showing. You have you need to be at $1,000 for this particular credit card. So what it's saying, for this particular credit card, I need to I need to pay off $4,000. Okay. This next one, you're at 25, there's 1,000, so nothing. And then here again, another scenario. So you have $5,000 you need to shave off to get to 10% for that particular card. So overall, you can see you have a $45,000 difference on a per card basis. But if you're looking at the total, to be below 10%, you need to pay off $525, because your total is $6,000 is what makes up 10% of your total credit card limits, all in all. So that's just something to look at. You do want to look at it, by card and as a total. So I would recommend probably paying off at least for sure, getting rid of that 525, and then starting to move through the rest of these cards so you can balance your credit card score, your credit rating, as well as the individual cards. In this, as you're scrolling down, what we have is this is looking at your total card balances altogether. We've only gotten through Q3, Q month three, so that's Q1 of this year, and this is breaking down, the different charges that were had per category, and the categories again are the ones that you chose. This is a formula, so it'll just reflect anything that you keyed. So if you change some sort of category in this particular file, it will automatically show up on here. So what you have is you're looking at it monthly, quarterly, and then you have the whole year. These future months are projections. So overall, what you can do is, well, this is the sum of the total cards. So let me scroll down. So if you go in card one, what you're seeing is, this should actually just be zero. That's what I'm going to do. An estimation of how much you think you're gonna spend each month based on how you've been spending, or based on what you know is coming up. So what you could see here is in beauty, not planning to spend any at this moment. Maybe there'll be something, who knows? But it doesn't need to be $659. Here next you have business expenses. There's particular things that you're investing in a business, right? But you don't plan on continuing it here. So there's a hard key right here to say zero. Some of these other ones are just equaling the previous month. That's all that is. But if you have a change, then you change it. So you're expecting 119 to come through, and that's going to equal 119 for May, but not for June, and so on. Entertainment, you plan to pay the same amount. You got fees, that was just a one-off. You have food, planning to keep that constant. Maybe it goes up, but maybe you need to change and look at each month by month. Maybe somebody's birthday is coming up, and that's where you need to plug in your boyfriend, your husband, your whatever, your child's birthday, and that's going to go up for that particular card. And you can plan that if you know you're going to put it on this card. Your groceries, home issues, this was an unexpected expense. So that's a random one, but you put it on the card so you can get the points. Medical expenses, personal development. You plan on having this charge, but not all the way through the year. So that changes. So on and so forth. And then you have your other cards below. So that's something to really understand what's going on each of your cards. Again, having one makes it really easy. But sometimes you just want to have that one small little rinky dinky payment to keep the card usage flowing, so they don't shut it down. So next, what you have is your dividend investment. So remember, we had our goals chart, and we had a dividend investment goal of 2,000 a month. For now, it's going to be a little tighter, but your dividend investment currently is 343. So that's where that is equal to. So let's go back to step 4. And you can see that 343 is coming from the cell J10. Overall, what you have is order of actions, right? This is based on, after you play around with your numbers, it's like, what do you want to target first? Here's your stock symbols. Here's the current price of it. Actually, I want to move this over here, but I'll do that after this. The current price, the current shares that you have, dollar cost averaging. So like, what, based on when you purchased it at that price and the number of shares, this averages it all out. your total investment based on the price you paid, how much dividends you get per share, what you're getting monthly based on the per share. And some of these are different. This is averaging it out by month. Some of these stocks are quarterly payouts. So there's some little divide by threes and all that kind of stuff. And it will fluctuate. You really have to play around with it and adjust it as you go. Um, then you got your annual dividend payment. And all that is doing is times 12. So this will continue to change as you add more. You could see as you scroll down, there's you have your date, your stock, your number of shares that you bought, what you bought it at, and then the total based on one times $11.06, right? Um, so then moving over to this next section, you have your immediate targets. So one, take into consideration what is my income right now, what can I achieve reasonably. Let's think of an immediate target as within a year. Maybe it can be shorter based on certain scenarios. Maybe you come into money, maybe your taxes, you get your tax returns coming in, or whatever have you. It can move a little faster, but maybe be conservative and say, like, okay, my paycheck, I have this much extra cash. This is what I have. This is how I can move. So with that in mind, what is giving me the most payoff per month, um, and then going from there. So, and what, from an affordability standpoint, risk component, what are the types of stock? Is it a REIT or is it a business? Is if the market, REITs are required to pay out a certain percent of their revenues or their profits, um, to the shareholders. Period. That is just a rule, period. They can't take that away. But if you have a business, like for example, this is Intel, if they have a rough season, they can choose to just turn it off, and then not pay out the dividend. So that's something you have to think about, why you want to go with a certain stock over another, or a certain ETF or whatever have you. So with that in mind, it's like, okay, I want to make $100 per month off of this particular stock. $100 a month would get me $1,200 per year. To In order to get that $100 a month, how many shares do I need to achieve that? I need uh, essentially 1,300 shares. But I already have 327. So what I need is 1,006 more shares. So the balance to achieve that is, 1,006 shares. BTA is balanced to achieve. And then the total dollars to get there, based on my dollar cost average is, is essentially $9,300. So you can see that calculation is doing that. Actually, no, I updated it, the formula, to based on the current stock price. So you would have to, every time you go in and update this, just check your stock prices. Because with that, you can get a more realistic idea of how much it would take. It may increase or decrease. This dollar cost average, this is a moment in time. So one of the key things you can think of is, like, right now it's $9.24. So far invested $10.10 on average. So seeing a lower price, maybe that might warrant, if there's cash sitting around available to spend, not your emergency fund or anything like that, then you can consider, maybe I want to buy a little bit more if it dips. It can get me there faster. I can show you this example on the right. Let's go over here. So this is saying, if the price is, and this is saying off of the dollar cost average, so based on what I've already been paying, if it's 10% less than where it's been, it would be $9 essentially. If there's a 25% drop, $7, 50% drop, $5. And then just keeping that in mind, that same 1006 shares uh, could turn into $9,100, $7,600, or $5,100 based on any kind of dips in the market. So um, that's something to consider too. If you do have a kitty sitting around waiting for certain opportunities that come up, you could save up to $4,000 if that price went down to $5. So if something happened in the market and it went down, there's your opportunity. I can tell you in 2020, this particular stock did go down to like it was at $6. So that's that. And here you can see the variances to that. You say $4,000 here, about 1,700, and only a few dollars here. So yeah, so just note those opportunities. Long range targets. This is saying, hey, I want to have $12,000 per month for each of these stocks. Annual dividend would come up to $100,000. And how many shares would I need overall to make that happen? So the balance to achieve that is 2.2 million. Number of shares 107,000. Again, you have to continue to watch and check on the dividends, see how much they're really paying out. So again, these numbers will fluctuate depending upon what type of stock or ETF you have. Definitely lots of benefits to certain ETFs, and do your research. And pick your stocks based on what your knowledge. And I say stocks, I'm using that loosely, as in like could be ETFs, could be mutual fund, whatever have you. Do your research, manage risk. Then your last tab is now you're looking at your budgeting. So what I typically do is I plan out my numbers based off of my pay periods. You can see this funky number of it's going from the 16th and then the 1st. For me personally, my W-2 job, we pay on the 1st and the 16th. Weird, but that's what it is. So you can do the same for yourself. And you can see here that all the pay is plugged in. Where does that pay come from? The W-2 tab. So if your pay goes up, this will change. It also adds in if you have your hustle money or your additional income divided by 26 weeks. Next, then you have your mortgage or rent. Well, here's what I will do. I can say slash rent. Um, so you have electric, gas, internet. So we already flashed this screen. So your electric, gas, internet, water, that's totaling your utilities, and then you have your mortgage. Super important to understand this because that helps to support what is your emergency fund that you need to make sure you still have a roof over your head. Other numbers you have are your loans. So loan one, two, three, whatever have you. Many of us have student loans. Hey, fun. And then just calculating those payments. What I didn't go over is row 8. So this is just current balances and targets. So your loan balance, just to make it easy to view, maybe you have 1,000 here, you have 5,000 there, and you have 500 here. Obviously, this number would change a little bit if you have 500. Let's just play with this and say divided by 12, because it wouldn't be $300 a month. For that $500. It could be, then you can do it that way. Typically loans obviously have a monthly payment. So if your monthly payment maybe was $25, but you want to say, hey, I want to pay a little faster, and I want to pay it this year, $42 a month would get you there. Or you could just enter in whatever your payments are. Maybe the payment was $300 because this was a bigger loan, and then just hard key over this and just say, zero. The rest is zero. If you end up paying it off, like maybe you have $500 there. Just notice as I'm changing all of these numbers are changing. So undo, put it back. Yeah, we'll keep it at the 42. We're saying we're going to pay it off in a year. Credit cards. Now, here you have your credit cards, and this ties back so you can see your charts, the credit card expenses. So this just really equals these numbers, your current balance. And then what you have is your total credit card, what you're paying per year. This particular calculation is saying, I know I'm going to pay my balance off in full on this particular pay period. And these numbers are wacky just because they are. But I'm going to pay this particular balance off. And it is saying, what is that total payment for this particular month? So there's a little month calculation here. It's taking this and just making that month one. And it's doing that all the way down here. So if we can see, we can go over to this credit card tab, 4730, and you can see credit card one for month one is 4730. For month six, it's 806. Let's go over there. Month six, 666. Doing on the 16th, 806. And these other months, these other cards don't have anything because we didn't put any cards in there in the data, and then forecast them out. So this is just a good way of saying, like, based on the money coming in, you know, do I have extra cash or am I missing something? This could be okay if you're saying, hey, maybe I need to keep this 174 or sorry, $74 and this is going to pay off that. So just play around with it yourself. You got your life insurance for any of those with life insurance outside the job. I personally like that idea. So it's like I can, while I'm still quote unquote young, um, I can catch a good deal for a nice hefty life insurance if something happened and I needed to pay off this house or whatever have you. Investments. So your Roth IRA, try to meet the max. I think this max actually has gone up. So what does that look like per month for the full year to get to that max? Investment accounts. What happens here is this is saying like, what's my target? So this goes back into current balances or target. So my target is 16, almost $17,000. Where is that coming from? Cell N10 from the dividend tab. So we are going to N10. So that's balance to achieve. I gotta put 16,000 or $17,000 aside in order to achieve these targets. Maybe, if let's say there was a dip in the market, that number could be, instead of almost 17,000, it could be almost 13, or it could be 9,000. So it's just keeping an eye on the market or setting up alerts, really. If you ever see any sort of drastic decreases, that can help you reach your goal faster. So again, some of these things like a REIT, that their margins are their margins. The stock market is going to change and fluctuate however it changes and fluctuate because it does what it does. That doesn't necessarily always mean it ties back to the books or whatever have you. So you have to do your own due diligence to understand managing your own risk. All right. So coming back over here, we have our, investment accounts. So that's where that ties back to. And then for this instance, I'm just saying divide by 12, right? If you're actually starting a little later, then you need to divide by the remaining months and put it here, and you can just zero this out. Savings, here I have here's an account for emergency fund. That emergency fund is coming from the current. Then we have emergency fund plus your fund money. Actually this math doesn't math, but I'll change it. So we can say this one is your fund money. Your fund money, actually, no, that doesn't make sense. Your emergency fund plus your fund money goes here. Actually, let's adjust that. I like that. So we're saying our fund money is $3,600. So what we have to do is say I need this divided by 12. And so that's $300 a month in order to have my fund money, right? And this again is your savings. Um, so just keep that in mind. If you really wanted to reach, and so if something happened, you'd have 3 months of emergency money at the end of this year. And then you also have $3,600. So you can essentially maintain your lifestyle. Would I do that at this rate? I would probably hold this for another month. So I'd have an extra month of real emergency money. Ideally, the 3 months would be 6 to 12 months, because that would really reduce your stress if something were to happen to you. Then we have other opportunities. We're just saying no target. Let's just throw some money in the savings. So if something random comes up, I can do that. So in the checking, what I have here is fun money stash, annual gifts, random activities. So putting this aside so you have cash on hand for that. In a perfect world, what I often do is pay these things with my credit card so I can get the points. Um, and then I go from there. That's why I go through the due diligence of making sure like this credit card bill has to be paid off and doing that exercise. But if you don't want to use credit cards, you could put it here and that's it, and these would all be zero. But that's something. So if this payment is already accounted for over here, then just consider this would be money you can use for other opportunities. You can put it in your investments. You can move faster with that. So just keep that in mind. Different ways to look at things, but it's sometimes nice to clearly see these things separate over here. Um, these credit card pieces, that's something, you're seeing that certain expenses are constant. So just consider that. And then you're going into the next year. So what I have here is this emergency fund goes up to the target, your goal, and so on. And then you can see here your pay also goes up. In this calculation, what I did was I took the current W-2 and I did 5%. You could change it to your W-2 target, which let's bounce back over here. Um, and this says 20%. So if you know, like, hey, you know what? I can get to that 20%, throw that puppy in there. But just know there's different little things you can do and it just repeats itself all the way down. Um, so that's something thing. So you can really think about here's how I have to move and groove based off what I'm making right now, what I can do, and then here's ideally the next year where I'm going to be, how I'm going to be playing. And maybe next year you're actually going to do this a little bit different. This is just an average based on the total year. This is something you can potentially get rid of. This average is taking like your total annual credit card expense divided by 12 divided by 5 cards. So that's all that math is doing, and it's just an average, just so you have something plugged in. Hopefully that number goes down actually, and your average goes, So just consider that. Now the last tab is you have all these goals. I'm gonna hustle. I'm gonna do all this stuff. Think about your time management. How many days, how many hours are in a day and in a week? So what we have is you have 24 hours in a day, um, and then 7 days, 7 days a week, and then you have 8 hours of sleep and seven days um, of getting 8 hours of sleep. So it's saying on average per week, I have an additional 112 hours to do something. So that's your target. So what you have is your W-2 job, right? 40 hours commuting to the W-2, 3 hours, your passive income. So this is like additional income one, additional income. number one. Uh, that was what's on the goals tab. Let's go here. Your dividend stock analysis. So you want to make sure you're taking time to look at that. We're saying 1 hour here. Physical health. 2.5 hours. What's that doing? It's saying half an hour, 5 days a week. Mental wellness, half an hour, 7 days a week. Entertainment, 2 hours a day. Reading, half an hour a day. Learning and growth, an hour a day. And then you still have, what is that, almost 22 hours left. Now, give or take a few things, the 40 hour, no, you can keep that actually, JK, keeping that. So you can see overall for the year, the breakdown from a percentage standpoint. Your W 2 is taking 44% of your time. So that's time you're not going to be able to put into these other things. So you really have to consider, how are you going to use your time? Are you delegating? Are you working smart? Are you taking that time to plan ahead? And then when you have, you know, look in the future, all you have to do is just plug in, you set it and forget it. And that's the whole point of this template, is to set it and forget it. Granted, you go in and you dabble or whatever a little bit here and there with your dividend stocks or whatever have you on, and your credit card expenses. Maybe you're just going to do it on a quarterly basis to just make sure you are tracking to where you wanted to. Your W 2, you're not doing that again unless something changes. But your annual budget, how I normally use this file is I go in, I get paid, yay! And then I'm just like, okay, this is paid. I go in and pay this, and I change it to like green, done. That's paid off. And then I repeat and I go through. If there's something that is automatic payment, I go in once it's paid and I see it's out, green, green, green. And that's the way I move and groove with this. The saving targets, this is where I move around. If maybe something comes up and I need cash and I don't want to take out of my savings or something, I can I can always pull out of here. Especially if I know I'm planning this fund money and some of these other things in my credit cards. So this section over here kind of is my cushion. So this is the way I normally go through my budget. I also have a Wave account, that's actually nice because it puts it in a nice little pretty package. But to do the day to day paying, or the week, the twice a month paying, this is the thing that helps me to understand changes in how my 401k was moving and grooving and what the actual pay is going to be. I used this because this directly impacts my budget. When I increase my 401k payments or contribution, this number is going to go down, that pay. So then that means I have to account for it over here somewhere. So that's the whole goal of this chart. My dividend investments, this is just, I use this particular type of chart to just understand how much did I actually pay for, because not all the applications have your dollar cost average. So that's why this is helpful. And then especially with planning for the future. So really understanding, like, how can I get this extra cash? Because, the way I think of it is, if I have that money there, it can either A, help me get to these bigger goals faster because I'm just reinvesting this, or B, it's something that's paying for my fund money, right? Or it's paying for opportunities or whatever have you. So that's really how I look at this particular sheet. And most of these, I think, are set up to print in a nice little nifty manner. So yeah, so I will put this in the a link to this in the description, so anybody can just copy it for themselves. It's a freebie. I make tweaks to it, so if you ever want to look at a new copy, then it's going to be there. But yeah, so this is how I really get to paying off debt, getting to certain savings points, etc. I am definitely not a financial advisor, or this is not a, you know, seek a financial advisor for specific things for your particular position. But as far as systems for looking at my numbers and things that are adjustable, very easy to work around. Like again, I could just insert a row above because I'm going to add something. Even on my budget tab, if I have another card for whatever reason, insert another row. I could play around with it. So some of the apps that are out there, you cannot do a lot of that adjusting and modifying for yourself. Maybe I get paid weekly, right? Or once a month, right? So you want to change it to fit how you see your money coming in and out. That's the important thing, is adjust this. And I don't always even use this perfectly. Sometimes I know I have this other little kitty or whatever, and I'm paying something because I want to just get it out of the way or whatever have you. And I'll put things on the side to adjust. But you use this, make a copy. What you're going to do is just actually go in here and then you say make a copy. You can also download it as an Excel file for your own liking. Everybody works a little differently here and there, but that's that. This is how I really manage my goals. I really get super clear. When I really executed a lot of things, I got super duper clear on the targets that I needed to get to. When you go on law of attraction, manifesting, whatever, super clear. I got super clear with my goals. And as opportunities came up that were in alignment with my clearly stated goals, I was able to quickly jump on those opportunities because I was clear in where I was going. So that is that.